Hey guys, Whitney here. Welcome. I'm going to give it just a minute for people to file in the room. And I want to make sure that I have the right file pulled up for you guys. Happy Friday. If you guys would jump on over to the Q&A box. There we go. And let me know where you guys are joining in from. I would love to know. This helps me kind of just like chat with you guys, but also learn where you guys are coming in from. What is the burning question you want to get out of today's webinar? Now, guys, today we're going to focus on how to vet passive real estate deals. Okay. We have time for other Q&A. I'd be happy to indulge you a little bit. But when it comes to vetting deals, okay, I want to know your top burning question or questions so I can make sure to tailor this to you. And if you guys would do me a favor, make sure to find your Q&A box. That helps me stay organized. The chat box I won't be looking at very regularly during our session here. So make sure to move everything over to the Q&A box. That would be amazing. All right, let's see. We got people joining from Ohio, Chicago, Minnesota. Hey, Trish. The Big D in Texas. I think that's Dallas, perhaps. Good to see AP. New York, Spokane. Awesome. Amazing, guys. Okay, Virginia. Hawaii. It must be pretty early in the morning for you there. And Alexandria. Excellent. All right, guys. Well, let's go ahead and dive in because we have a lot of information to cover today. Some of which, if you've been following different parts of the bootcamp series, I'm going to do a little quick backtrack on a screening process for operators and markets. Very quick. We're going to touch very high level, and then we're going to move on and spend a lot of our time on the actual deal. We're going to go through terminology. We're going to go through math. We're going to, show you different parts of the PPM and where to find this information, how to read it. And then I'm going to give you kind of like bullet points that you can take and put and build your own vetting sheet. Okay. And I have a very specific framework. I know there's a lot of, vetting lists out there that people use, but I want to give you a framework on how to think about these questions, right? It's not just a list of questions that you're trying to answer. There's reasons why you're asking specific questions and what you're really trying to get at. What are you trying to tease out of that deal? What are you trying to uncover? All right. So before we get started, a quick agenda today. We are going to talk about the biggest myth that keeps investors from investing and keeps them on the sidelines. We're going to talk about proper screening of operators and markets a deal. Really, what is that 10-second process that you can put in place to get to a commitment? Okay, that's not due diligence, but just to get to a commitment because deals are moving fast these days. Good, high quality deals are going to feel very fast because they're fewer and far between. The market has shifted. So I want you to be able to get to yes fast. That way you can then take the bulk of what we're going to cover today, which is your due diligence process, to really suss out the different parts of the deal and make sure you have everything buttoned up before you write that check. All right. So what's the number one myth that investors have? They tell themselves, I have no control when I invest passively. That is simply not true. You have multiple levels of control. It may not be day-to-day operational control, but you have multiple levels of control on whether you go into that deal or not, which deal you go into, who you invest with, what your goals are, have you aligned your risk tolerance, but more importantly, what are those questions that you need to ask yourself and ask of that operator and review in that deal material to ensure you've got all of this aligned together, right? You have an immense amount of control, and I want to empower you today. All right, if you guys don't know me, I know I see some very familiar faces on here, but if you don't know me, if this is the first time joining one of our boot camps, these boot camps are meant to be hands-on, tactical, operational, teaching you a vital skill, not just like a 30,000 foot view, high level view of what we get in our masterclass sessions, but really deep diving into, when you walk away today, you should know everything that should be going on that vetting checklist. At least 95% of those details that you need to be covering in your vetting process for a deal. You should have all those bullet points for that checklist. You should be ready, set to go and start screening deals today. All right. But my story, I started real estate investing in 2002. Started living, flipping, and house hacking. Got my husband to join in the antics with me. We got really good at building equity. We transitioned into single family real estate, built up a very sizable portfolio of homes there. But we realized that was it was time leveraged and quote unquote passive income, but we were still spending an incredible amount of time managing all different aspects of the property. Why? Because we were the operators. All right. We had to go out and find lending. We had to research the markets. We had to find the deals. We were doing all these pieces. Now, don't get me wrong. We had to start here, and it is a very, very powerful place to start. Okay. However, at some point in time in your portfolio build, you might realize, hey, I have a higher and better use of my time. I want to elevate myself to from COO to CEO of my business, and either reposition assets or potentially just shift the income out of one asset into another and start building out passive portfolios. And that's really what happened for us. We decided we wanted to spend more time with family and friends, take advantage of these golden years with our daughter and travel. I joke around all the time. She's 10 and a half. She still likes me. I'm sure there'll be a time where, she won't want to be around mom so much anymore. So I'm taking advantage of that, right? This is the season of life I'm in. And but anyways, passive investing, that tool has really allowed us to do that. Okay. It's not an either or. Do I need to have my personal controlled real estate portfolio of like single family homes, short-term rentals, midterm rentals, or the like, versus passive investing? It can be an and for you. And, we are going to dive into different ways that you can utilize both types of asset classes to really scale your wealth build. Today, we're focused on vetting the deal. So for those of you who are here and want to passively invest, you've got a tangible process to execute on. All right. Now, don't forget to drop in that burning question that you want to know. I only see one question so far in the Q&A box. What is that burning question that you want to know, have answered about vetting deals today? All right. All right. So I told you a little bit about our story. Where we're at today, we've got over 6,500 residential units, 2,200 self-storage, 7 car washes. We've got a couple other businesses that we run. This is us personally, my husband and I, but what all of this allows us to do, doing this in partnership and doing this very in a leveraged way, is it allows us to gain results. And that result, what most of you are here to share in today, is how do I get time freedom, choice freedom, impact freedom. Okay. Now, this is the only plug I'm going to give today, but here at passiveinvesting.com, if you're down for investing passively, want to get access to those deals, we can help you do that. We've got a very large portfolio under management with excellent returns to our investor, and we can help you do that. I'm going to give you contact information. I'm not going to make you wait until the end if that's what you want. But I also want to put out a disclaimer today. What we go through here is educational purposes only. I highly doubt we're going to get into any financial models or legal advice or tax advice, but if we touch on that, if a question comes up, just know that what works for one person may not work for another person when it comes to financial, legal, or tax advice. Okay, be very careful with that. Make sure you have your team built and that you're consulting with them before making any investment decisions. All right, as I promised, if you want to reach out to me directly, if you're not already on our passive investing list, if you want to have a one-on-one call about your real estate goals and how passive investing can help you, if you want access to future masterclasses and boot camps and priority access to our deals, you can just scan this little QR code and that'll take you right to the website. The website is passiveinvestingwithwhitney.com. All right, intro out of the way. Let's get started into the meat of today. All right. So about once a month-ish, I do a boot camp, and we have been building in our skills with this boot camp. Back in September, we did a boot camp on how to set your real estate goals or your investing goals and understand your risk tolerance. Okay. If that is where you at, that is where you start. This will be today's session will be beneficial for you. But if you're like, I don't know what my investing goals are, great. I go back and watch that boot camp. They're posted on your YouTube page at passiveinvesting.com. Dot is spelled out, DOT. And you can get access to that boot camp for free. That'll help you walk through your goals and risk tolerance. The next month, we went into the control piece, which is setting up that high level screening process to get to yes. Now, I realize today, many of you didn't attend those previous two workshops. So I'm going to go over the screening process at a very high level before we move on. So we're all on the same page on vetting deals. All right. So we're talking about control. Okay. But first, let's define what control is. Okay. It's a verb. It means determine the behavior or supervise the running of. It does not mean mitigation of all risk. You cannot possibly eliminate all risk. All right. So control means that you're looking at the behavior, you're supervising the running up, and nowhere in here does it mean elimination of all risk. All right. So I like starting off here with the definition of control, because I think a lot of investors actually they misunderstand what that word actually means and what we're trying to do here. We're trying to uncover kind of, find the red flags, if you will, but we can't possibly find everything, right? Even if you do a high quality vetting process with a high quality operator in a fully stabilized market, something could possibly happen that is beyond your control and that could affect the business plan of the asset. Okay, but what we want to do is figure out, are all these as much risk mitigated? All right. So let's think about other assets that you might be in. Stocks, bonds, and mutual fund. Do you have control? Do you actually get to supervise the running of the stocks, bonds, and mutual fund? No. If you hold mostly cash investments, do you get to, supervise like what the Fed does with changing interest rates and, devaluing money? No. Okay. But this is why I love investing in businesses and investing in real estate, is because actually those are two areas that you can exhibit a lot of control over. Okay. And it's because you can actually determine who you invest with, where you invest in, and what you invest in. All right. So again, let's start with the screening operator. And I know somebody here says, how do we know if the syndicator is not a scam artist like Bernie Madoff? Well, we're going to give you some, first, you're going to want to pay attention to this section. Second, you're going to want to also stick around to the end of today, because we are going to talk about legal underwriting of the operator. All right. And that's, I'm not going to put these things out of order, but, make sure that you're paying attention to those first two sections for sure. I'm going to take a minute to kind of clear the board here. Okay. All right. So the first rule of investing, taking this information from Warren Buffett. Number one rule of investing is to not lose money. The second rule is to see rule number one. We're gonna actually see this quote a couple times today. So if one of our past setting our own goals and our risk tolerance, now we're going out to find that operator we can invest in, the person, the who. Okay, we got to figure out who can run the business and not lose money. All right. For those of you, there's questions coming in. Is there going to be a recording? As always, there will be a recording. Okay, guys, no problem. Just wait for that email to come out, probably on Monday or Tuesday next week. All right, so let's talk about it. Let's define who the general partners are and what a limited partner is, because we need to figure out who the who is in this transaction. So the general partner, and they can actually be a sponsor or an operator. So they could be part of the puzzle piece of running the deal, or they actually are handling the day-to-day operations. The operator is the day-to-day operator. Okay, they are handling the day-to-day operations of the asset. Here at passiveinvesting.com, we are the sponsor and the operator. Okay. A lot of times when you invest with other types of capital raisers or capital groups, you need to ask that question. And I'm going to go through that to figure out what their role actually is in the deal. But the general partners are what they're doing is they're participating in finding, conducting due diligence, purchasing the asset, completing daily maintenance and management. They're doing refinancing and lending decisions. They're handling any sale decisions. And they elect to take this active role for a return of cash flow and equity. They are running the business on everybody's behalf to get paid in cash flow and equity. And they're also bringing the team here. They're bringing a lot of people, brokers, lenders. They're finding all the construction workers, property managers, insurance, legal, tax, anybody here that has had their own personal real estate or run their own business. It takes a village to run a business. Okay, the operator or the sponsor, they are taking care of that puzzle piece. But what do you get out of this? As a limited partner, you're the investor. And your role is to perform due diligence on the information that's presented to you, okay? Fund your investment and respond to any general partner request. Seems pretty time leveraged, right? You know, you're not a whole lot of work, but you're reaping, shares and benefits of the LLC class. Well, the limited partner, they elect to take this passive role for a share of the profits and time. Now, why would somebody want to step into a more active role versus a more passive role? Well, the GP generally, they have the deal flow, they have the ability and desire to actually manage the deal. They got the time, they have the people, they have the systems, they can get a hold of lending and credit, but they may not have all the capital to scale the business like they want to. The LP, okay, the limited partner has capital to place. That's what they have, but they may not actually have the deal flow or the ability and desire to manage the deal. Okay. Or they may not have the time, the people, the systems, and the lending and credit. Or maybe you are an operator in, say, multifamily real estate, and you can't become an expert in car wash deals and go now open up your own car wash. You're getting spread too thin, right? Maybe you are an active operator, but you now need to diversify. So you take your money from the active deal and move it into a passive environment. Right? So those are some reasons why. This is why the relationship works. Now, if you noticed, all those things that a general partner, the operator sponsors are doing, they are operating a business. You're investing in a business. So you need to vet the business owner and make sure they are somebody that you want to do business with. Right? This is not like investing in stocks, bonds, and mutual fund where you talk to a fund manager or even just like some sort of fiduciary and they just say, hey, here are the returns, okay? You are skipping many steps there, right? You're forgetting about who are the actual businesses in the fund, what are their books like, what is their forward-looking projections, do they have a succession plan? You're forgetting about all that because we have been trained to look at yield only. When you're passively investing, you must learn to look at the operator. Okay, it's the who, not the how. If anybody's read that book by Dan Sullivan, amazing book. So we got to ask ourselves some questions. Now, somebody put in the Q&A, hey, can you hand over the checklist that you have? I'm giving you the question. Okay, take screenshots, build your own checklist because you want this to be in your language, not my language. You want to add your questions to here too. But please take screenshots and add this to your checklist, all right? Do you like them? Do you think they are genuine, authentic, transparent? What is their background? How many deals have they done? How many have they taken full cycle? All right, what is their expertise in the area? Who's on their team? What are their roles? Okay, can they actually support the investment that they have? Who's actually managing the asset? Now, guys, I have some double asterisks to stuff next to things. These are a cue to me. There is no small print title that you're missing out on here. But who's managing the asset? This is an important question, right? This will help you understand, are you investing with a co-GP or sponsor or the actual direct operator at the deal? Now, there's pros and cons to both, all right? But this will help you understand that, and you will want to know, because you want to know who's doing, making day-to-day decisions, and what if they aren't making day-to-day decisions, how are they able to influence the deal on your behalf should something go sideways or south? What is their typical investment strategy? Are they doing buy and hold? Are they doing flipping? Do they have a long-term strategy? Or are they doing more short-term strategy, 3 to 5 years? What markets are they investing in, and what kind of returns are they generally producing for their investors? What are the major risks of their investment strategy? Now, I actually asked that question verbatim to them. Like, I want them to give me information beyond just like the SEC, 5 top risks of investing, that you can lose all your capital, suspension of distribution, business plan, and stuff like that. I want them to tell me, well, these are the risks that we see, and this is how we're mitigating those risks. All right. Lending today, guys, that is a huge risk. What are they doing to mitigate, risk with their lending? Are they using adjustable rate mortgages? Are they getting caps, extensions? Are they using fixed rate debt? Are they doing seller financing? What is the term on everything? You want to understand the lending, and we'll get into the vetting process on that. How do they communicate? How often do they communicate? Do they give you financials? When will you get your K1? How often do they distribute funds? Is it monthly or quarterly? Okay. Now you need to build your checklist to understand what you want to see. Okay. For us, we communicate on a monthly basis. We give out quarterly financials. We target to get K1s to our investors by March. We have restructured our process to hit that timeline this year. And, on our assets, we're looking to distribute monthly or quarterly, depending on which asset. Have they ever had an asset go sideways? All right. If they have, I'm not looking for 0 bumps in the road. Actually, I'm looking quite the opposite. If they've had, I want to see somebody who's been tested a little bit, and how did they respond? Are they good business operators, and they're able to make the hard decisions that they need to protect the asset and protect investor capital? Or are they letting things get so down like the rabbit hole that now they're doing capital calls and stuff like that? What is their waterfall? Sorry guys, typo in there, but what is their waterfall? What are their fees? Are there any GP catch-ups? And we'll talk a little bit more about that later. So these are the questions that you can ask to kind of vet an operator. Now, we have some red flags here. Now, this doesn't actually keep you from, this isn't going to suss out a Bernie Madoff, type situation. I'll get to the legal review here in a little while, but this will help you maybe kind of like not step on some of the major landmines of why a deal might go sideways or south. All right. So Dan Handford, one of our managing partners, he wrote an article, The 7 Red Flags of Investing. Now, he's actually added an 8th, and I've dropped it in on here. But so really what you're looking for, and everybody has to get started in business somehow. I get that. But at some point in time, you need to ask yourself, where is your money most protected? So if somebody hasn't had a successful background in business, I don't know if I would invest with them. If they're a part-time operator, that's a question mark too. Like, is their heart really in the game? Are they really, do they have the time and ability to do the work? And I would actually, some of these don't stand alone by themselves, but if somebody has no successful background, they're a part-time operator, they're the only managing partner. Ooh, I got a problem with that. Now, if somebody might be part-time, but there's 2 other managing partners who are unrelated, very important, unrelated. That's for succession planning purposes. That's also for, commingling of accounts purposes, right? That sort of thing. And one of the partners has a very strong background in business. Now that partnership looks a little bit more attractive. All right. Number 4, they have no preferred return or a preferred return with a GP catch-up. Number 5, they're modeling a refinance into the pro forma. I see several groups do that. If you do see that, ask for the underwriting and back out the refinance because it makes sure the returns work before you invest. You should be able to just remove, like, take the refinance proceeds, turn it to a zero on their underwriting Excel spreadsheet. And now you should see everything else, what the actual returns are going to be for after the, where they would have done the refinance. If things still look good, cool. If the returns were reduced because of the refi, now you know that the whole business plan revolves around them having to do a refinance. Ask them if their distributions are a return of capital or a return on capital. One letter difference there, of and on, but that can really impact your actual return that you get as a limited partner. Okay, are they co-investing in the deal? Right. Now, sometimes early operators don't have the pocketbook in order to co-invest in all of their deals. However, you do want to see some sort of skin in the game. One, not so you guys are aligned, right? But then number 8, especially in this past year, you want to make sure that if the loan is an adjustable rate, that there is a cap. All right. So if you see an adjustable rate mortgage with no cap, it's time for the run for the hills right now. All right. All right. So that's screening the operator. Those are some high level questions. And that is you jumping on a call with the operator. I know a lot of investors, they say, I don't have the time. I'm just going to look at their information online. I should get enough information in the OM, and I'm in an investment group, and I've talked to a couple buddies and they've invested with them. That's not due diligence. That's not screening the operator. Take the time. You're trading your hard-earned dollars and time that you've invested to get those dollars in order to invest with the operator. Take the time, jump on a call for 10 or 15 minutes, ask these questions, clear these things up. That way you have done your due diligence on this. Now, time for the market. And again, this is the screening process because I want to save the bulk of our time on actual deal vetting. So from a screening standpoint, we want to make sure that we are looking at the market, the sub-market criteria. Now, I have some specific things that I look at here. I like investing in growth markets. So I'm looking for markets where the population is increasing, jobs are increasing, job diversity is present, incomes are growing, crime rate and poverty are coming down. The landlord laws in those states, if I'm investing in multifamily or mobile home parks or something like that, they're friendly to business. That way the business has flexibility to work with the tenant. They also are tax favorable laws because taxes are one of your top expenses in real estate. But it's not just about the metropolitan service area, okay? You have to get down to the sub-market area of where the asset is, okay, where the operator is operating, and understand the local, what is happening at the local level with the population and job growth and stuff like that, but also supply and demand trends. Are people actually moving into the area? This applies to car washes too. You got to have people, coming into that area to sustain any business. Now, you can even get more granular, especially if you've got like an operating business like a self-storage or a car wash, down to the street corner. Where is that location? Okay, where are they investing? Now, that's generally going to be picked apart at the deal level because you kind of have to see the deal to know where the building is. But, do they have the traffic count going by? Are people actually stopping? Is it on the right side of the road? Stuff like that. So you want to make sure that you've got it, you're stacking your investing cards in your favor. Now, how do you research markets? So be sure you're going to get an offering memorandum. You might get some, ask the operator on an initial call with them. Can you send some market data? And they go, hey, we'll send you some offering memorandums of our previous deals. In those offering memorandums is information on Charlotte, information on Charleston, or whatever. Open up those, even if it's closed deals, open that up and you can start studying the markets. All right. You can also look for reputable documented data that's referenced in the OMs but also online from places like CoStar, Marcus and Millichance, CBRE, and they put out market reports. Those are all data, public data for people. Now, data, guys, is about 1.5 to 2 years behind our year. So if you're looking for 2023 market data, you're probably only going to get 2021 data. Okay, things move a little bit slower. Okay, so if you're like, I need 2023 data, you're going to have to call local real estate agents more than likely in order to get immediate market trends. All right. You can also go on to, for some people are like, I don't want to read reports. I need an easier way to look at market data. Try checking out citydata.gov or niche.com. Niche.com is one of my favorites because it'll actually show you categorize, like it gives it a grading system, A, B, C, or D. Really oversimplified. You're missing a lot of the nuance of the data. But that is also kind of like, for people that are like, ooh, timeout. I can't read the reports, or I don't want to read the reports. That is a great resource too. Or if you don't see the market data in any information that has been given to you, or you can't find good data that supports actually being in the market to invest, ask the operator. Okay, just ask them directly. Hey, can you provide this market data? All right, I got some questions coming in, a couple centered around this. All right, I think I answered the question on market data. Cool. All right. All right, so we're still in the screening process, right? These questions that you're setting up, you're doing the initial call, you are, on a high level reading about the market so you're familiar with them. That way, when a deal does hit your inbox, you can get to that yes or no really fast. So again, this is just screening. Now, the yes or no just gets you to, can I place a commitment? Can I be like 85, 90% sure I'm going to invest in this deal and place a commitment? All right. So I've already presented this to the group, but for those of you who weren't on the webinars in the fall, riddle me this. Are these good deal screening questions? What is the pref? What is the equity multiple in 5 years on this deal? When do distributions start? Are they monthly? What can I expect for a monthly return? Have you ever suspended distributions? Go to the Q&A box. I want to know, are these good questions for you to know if that is a high quality deal to go into? How do you know that deal actually fits your goals or not? Right? I say no. All right, because in all those questions, you have not actually matched the investment to your personal goals. Okay. You need to match your investment to your strategy and your risk tolerance. Those questions don't actually help answer that for us. They're all focused on returns and when do I get my money, right? How much money am I going to get? When do I get it? All right. We need to ask more intelligent questions. All right. When a deal hits your inbox, is it from an operator you have vetted already? If you have not vetted the operator, don't invest. Absolutely do not invest. The first step is to get on the phone first with that operator. All right. And you're initially screening, does this deal have any of those 8 red flags, right? Is it from, an operator that has a business background, that has a successful business background? They're full-time in their business, or at least somebody is, that there's more than one unrelated partner in that business. You can take a look at the lending pieces, the pref pieces with the GP catch-up, all those things. You want to make sure none of those 8 red flags are there, right? That is the initial kind of 4-point screening question that you want to ask in order to get to that quick yes. So for those of you who are like, I like checklists, these are the things you want to check. You want to understand the type of the deal, the location of the deal, and the business plan. That's going to help align you really fast. Does it actually fit your investing goals, right? If you're not looking for multifamily and you get a multifamily in your inbox, maybe that's not the deal for you. If you are looking for, a 5-year hold and you get a deal that's on a 10 or 15-year hold or into perpetuity hold, that's not the deal for you. So make sure that it actually aligns with your investing goals. All right. Does it have multiple pillars of wealth building? Does it have capital preservation, cash flow, equity building, tax benefits, smart use of leverage? All right. An amazing operator backing it. All right. You want to see multiple levels of wealth build. Understanding the loan structure. Have you reviewed the loan structure really, really fast? Okay. The loan structure and the capital stack will give you kind of like a high level quick screening on the debt. Do the returns right now look like they might hit your buy box, right? Your investment box. You're going to be looking at the preferred return, the IRR, the ARR, and the equity multiple. And we're going to dive into these deeper later. And is it on the distribution schedule that you want to be on? Now, right now in this market, you monthly and quarterly are still, very, very reasonable, schedules to get. I've heard a couple of times of operators moving to biannual and annual schedules. For me, that's a run to the hills situation. They're not managing their money very well. All right. So, all right. Why do you need to have that screening process, that initial like bulleted point, checklist? Why not just go straight from reviewing the operator in the market right into deal vetting? Well, one, you need a process that is going to save you time and help you get to a commitment fast. Okay. You also need to be able to get to a commitment with relative confidence that you're going to invest in a deal that's going to make sense for you. So that'll help save you time, headache, and heartache. All right. Now, if you get into the vetting process and you really uncover that the deal is not for you, that is a great time to have a conversation with the operator. All right. But really digging into the minutia of the deal comes after placing the commitment. That's where vetting is where the rubber hits the road, so to speak. So we kind of got everybody caught up from what we covered in the fall, guys. All right, I tried to keep that very contained. All right, just checking on the questions here. All right, so let's get into vetting the deal. Now, there's a lot of terminology that we are going to touch on through here. A lot of this I am going to define for you. I am going to show you examples of. We're going to talk through. But if there's any terms I encourage you that you don't understand, don't know, I encourage you to go to our YouTube channel. It is, again, YouTube. The handle is passiveinvesting.com. Is spelled out. And I have a wealth of information up there for you, but there's a lot of those terms that I've done like a short, like little 3 or 5 minute video on. All right. And again, as always, you can join our Passive Investor Club. We can give you some more. There's an ebook when you join here at passiveinvestingwithwhitney.com that you get, and that will actually help define some of those additional terms for you. All right. Now, somebody asked, do you have a checklist? Yes and no. Okay. I've sent, there are so many checklists out there, and all it is like a list of questions to kind of go through and check yes or no on a document. Now, I have found after multiple probably thousands of conversations with investors that a lot of people have their own checklist. They don't know why they're asking the question. All right. They don't understand why I'm looking at a particular area. How does it play into protecting one of the wealth pillars of the asset? So I really took the time to kind of take what I've done in the past, which is show you guys a checklist, and massage it into bullet points that you can now go and review to understand, am I protecting this particular wealth pillar? Because the more of these wealth pillars that you can protect in a deal that you invest in, the multiple ways that you're going to protect your downside, right? Because a deal isn't all about just hitting the cash flow number and hitting the equity number, right? Again, rule number 1, don't lose money, right? You can get paid, you get a percentage return based on tax benefits that come to you. The operator is the number 1 thing that helps you hedge risk in an investment, right? So you can actually get paid in multiple ways aside from just cash coming in the door. So let's really kind of understand, how do I suss out if each one of these pillars is being protected adequately in a deal? All right. So pillar number one, okay, capital preservation. This is our good buddy, Warren Buffett. I told you you're going to see this quote a couple times. But really, when we're looking at capital preservation, my top 4 things that I look at, that I vet out for a deal, is I want to, number one, understand that market. All right. I want to confirm those stats in the offering memorandum. All right. All those things that we just talked about in the market screening. All right. I want to understand those, and I want to confirm that data. So I'm going to go on really quick to like niche.com or citydata.gov, make sure that that data aligns with what I'm currently seeing published. All right. I also want to look at the comparable sales. So in an offering memorandum, the operator is going to share with you comparable sales. I want to see at least one, if not 2 comparable sales higher than the subject property that is being invested in. All right. That tells me we're not the top dog in the market. There's a little bit of room for growth. I also want to make sure that there's reserves. Okay. This is another way to preserve capital. If you're not forced to sell an asset, if the operator is not going to be forced to sell the asset, and if they are well capitalized to ride out any storm, then great, you haven't lost, right? So I want to make sure that the operator has a good depth of operational and CapEx reserves. So minimally, I want to see operational reserves at 6 to 12 months. Okay, now that's a lot of cash to have sitting on hand for operational reserves. All right, I want to see, if it is a rehab strategy, I want to see the CapEx, a large portion of that CapEx budget being raised. That way that the operator's not having to skim cash flow to replenish the capital expenditure budget. I want to see that all penciled in up front. We know what the numbers are. All right. Now here's the kicker. That's a lot of cash to have sitting on hand in a bank, earning 1% maybe return in an account. Right. If you're lucky, you can lock it up in a CD right now at 3.5 to 4%. Right. That's still like a lot of cash. You got a lot of drag there. Is the operator investing that cash somewhere? And if they are, where is it, and what's the liquidity of it? How well protected is it? I think this is again a part of the vetting process that investors don't quite know to ask. Right. So I would add this, especially right now in this environment. Liquidity is everything. Where is that cash being invested? All right. We talked about the sales comps. Okay. Are they higher than the subject property? Is there already a clearly defined exit strategy? And are there contingencies? At least one, if not 2. All right. If the primary contingency doesn't work, has the operator already thought of, through a plan B and a plan C business plan? All right. That tells me they can pivot quickly. All right. Now, not all of this can be actually stuffed into the offering memorandum. It would be just so big. So what is the other tool that operators generally give the investor to look at? And that is the investor webinar. It is worth your time to review that investor webinar, even if you just have it playing in the background on 1.5 or 1.75x speed while you're reviewing the offering memorandum. That will help you kind of pick up all these side comments and touches on the business plan that wouldn't be in the offering memorandum. All right, so those are the top four things that I'm looking to protect, that I'm vetting to protect the capital preservation downside. All right, wealth pillar number 2, cash flow. All right, so I am going to look at the pro forma. Okay, I'm going to make sure that it's conservative underwritten. So the pro forma is looking at the probably trailing 12, maybe trailing 3 expenses, whatever the seller has shown the buyer, okay, the operator, and the operator then is going to project out their business plan and what the income is going to be and how the expenses are going to shift. Now, I want that pro forma to be relatively conservative. I don't want to see them swinging for the fences, because we really can't predict what's going to happen in 12 to 18 months even. So I want to see that income growth is relatively stable. Now that is going to differ asset class, like from multifamily to self-storage to car washes. It's going to even differ within like multifamily classes. Is an A class property, B class property, C class property? It's going to differ market to market, even within submarkets. So that is something, probably somewhere between 3 to 5% income growth, maybe. It's probably pretty reasonable. If you see income growth outside of that, you want to ask why. I'm not saying it's not a deal to go into. You just need to ask why. Why are they able to project that? Now, same thing with expense growth. Our expenses are going to grow over time. All right. People expect, cost of living adjustments, employees do. So, taxes are going to grow. Utility bills are going to get higher. I have never had a year where my personal utility bills have gone down. So we want to see that type of underwriting too for expense growth. Vacancy. Or anybody who invested during COVID, all about vacancy. Occupancy, physical occupancy versus economic occupancy. So you want to make sure that the operator is actually doing very conservative projections on both physical and economic occupancy, right? How are they predicting that market's going to react in a recession, right? Are they underwriting those vacancy numbers in there? Or are they just being really starry-eyed and hopeful about it? All right, I want to see returns being conservative, all right? This is a rub. Investors are chasing yield on cash flow, on equity growth, all over the board. Everybody is looking for, it's funny, we are in a, very challenging market, and I have seen more and more investors chase yield, and I don't think they really understand the risk they're taking on, all right? But how can we get that yield growth in a conservative fashion, right? This could be the time to invest in assets that have a stability. They have some cash flow now, it's stable, and there's a stabilized plan to grow that cash flow over time, right? Those are the investments that I would like to see. Now, break-even occupancy. If we're talking multifamily, I want to see a break-even occupancy somewhere between 50 to 65%. That's historic vacancy, economic vacancy that we have never seen, all right? But if the deal works at 50 to 65% occupancy, amazing, because you're just now, if you can stay above 80%, you can certainly like float all the bills on the project, and the asset will not be at risk. Now, for those of you who are investing in self-storage, or other like maybe car washes or something like that, you're going to want to look at like the operational expenditure break even. Where how much of the income is required, current income on the project is required to cover all the bills. All right. And you probably want to be somewhere in that 55, 60% range as well. Now, somebody asked, is there a formula for this? Not necessarily, but what you should see a good operator will do is they'll put in what we call a sensitivity analysis, not only for the cap rate. We're going to talk about cap rate sensitivity analysis later, but also for the sensitivity analysis for the break-even occupancy. So they can show you as occupancy drops, how close you are to covering expenses, because even as occupancy drops, some of your expenses drop too, right? So, turnover costs, stuff like that drop as well. So, it's not a one-to-one linear calculation. So a good operator will actually put that in the offering memorandum, okay? Also, to protect the cash flow, I want to see rental comps higher than the subject property, right? Much like to protect capital, I want to see a sale comp higher than the subject property. On the rent cash flow, I want to see rental comps higher than the subject property as well. It gives me an indication that we have room to move rents in the market. That's amazing, right? And for cash flow, I want to see a distribution schedule monthly or quarterly. I think a lot of people really love monthly. I think any operator that is shifted to quarterly, I know many operators have done that. not knowing where they're heading into like the recessionary environment that we're thinking is going to materialize. I think it's a smart move, but I don't want to see operators move from monthly to biannually or quarterly to biannually. I think that that's an indication of something else going on in the business plan. All right. Just catching up with some questions here. Question came in. Does break-even occupancy, does that only cover debt or does it include all the asset expenses? So that is a great question. The operator should be covering all expenses, including the debt payment. Okay, now why do I make that distinction? Because right here we're going to talk about equity levers, and we've got our NOI, net operating income. All right, and maybe more importantly, when we talk about the cap rate, it doesn't take into account the debt on the property, right? Because if I purchase a property, I'm going to get a different loan than if you purchase a property, right? Our debt expenses aren't going to be the same. That's going to differ owner to owner based on our assets, our return profile, what investments we're invested in, that sort of thing. It should include the debt payment, right? Because the loan's not going to go away. What it won't include is the break-even occupancy. What it won't include are distributions to investors. All right, because investors, we're in partnership. General partners and limited partners are in partnership. We make money together, we lose money together. That is the definition, key definition of an equity partnership. Now, when we get into, talking about preferred returns, there are things that sponsors and operators do to better align the limited partner. They generally get a cut first of the deal. But that's not, I think a lot of investors, when they come into the space, they're thinking dividends, like a note dividend. Okay, that is not the case. It is not a dividend. It's a distribution of profits. If there are no profits, there are no distributions to be made. Okay, so that is a very important distinction, and I'm happy to dive into that. More so towards the end if we want to kind of tease that apart for people who are new to the space. All right, let's get into equity real quick. Let's see. So what do we want to see in a deal? What do we want to vet here to protect the downside on equity? All right. Well, one, I want to see a business plan that has a solid plan to increase the net operating income on the asset. Why that? Because that is the number one driver of value. Okay. Most assets, okay, if we're talking multifamily, self-storage, hotels, it's not, well, maybe not hotels. Okay, hotels are a messy middle of between business and commercial real estate. But let's say multifamily and self-storage. It is net operating income divided by the market cap rate. That gives you the value of the building. Okay, the more that I can drive net operating income, even if the cap rate is getting worse, I'm still making money on the asset. It protects my downside. All right. Now, conversely, when we're talking about like businesses, that we're not talking about net operating income, we're talking about expected gross income and some multiple of the expected gross income. So either way, we are still focused on the profitability of the asset. So how do we affect net operating income and the profitability of the asset? We have three main levers. One, increasing the income. Number two, decreasing expenses. And then three, adding additional streams of income. So when I'm vetting a deal, I want to see, one, two, or, maybe all three of those levers being pulled. Okay. So generally when I'm pulling all three of those levers, I'm probably in some sort of value add or development type strategy, but not necessarily. There are ways to pull all three of those levers, on a very light level, and then there's ways to pull those on a much harder level. Sometimes it requires more risk to get a deeper value add strategy. Okay, not necessarily bad. You just need to know what your goals are and if you're able to take on that risk. All right, another way, we've already touched on this, to protect the downside on equity, look at the sales comps. Hopefully we check that off in our capital preservation piece. If you haven't, make sure you check it off here. All right, now returns and sensitivity. We're going to spend a lot of time here, so I'm just going to go through at a high level of returns and sensitivity and waterfall. And then we'll dig into fees, and then we'll move on to deeper conversation of returns and waterfalls. But returns and sensitivity, I want to make sure that there is a sensitivity analysis that shows what happens when the market gets worse. We call that a reversion cap rate sensitivity analysis, right? A lot of big fluffy terms here, but really we want to see what happens when the market gets worse. Has the operator thought through that? And am I okay as an investor investing in that deal? Is there a preferred rate of return? Am I, as a limited partner, am I going to get a certain X percentage of the profit before the general partnership starts sharing in any profits? Okay. And then I want to look at the IRR and the equity multiple range. That will also be in the sensitivity analysis. Now, the waterfall, I want to make sure that I understand the splits to the general partnership into the limited partner, and that there's no GP catch-up in there. Essentially a way for them to make themselves whole before I start sharing an equity on the deal. There are deals that have that in there. Okay. Then I also want to make sure the fees are reasonable for that asset class and the market that you're in. All right. And I give ranges here because it depends, if it's a multifamily or self-storage deal. It depends if you're in Charlotte or North Carolina or like San Diego, California, right? You're going to have different fee ranges, expectations. But typically for a syndicated deal, you're probably looking at an acquisition fee somewhere between 1% to 3%. 2 tends to be the standard. That just helps the operator offset all the costs to performing due diligence, screening, underwriting, and performing due diligence on multiple assets to get the one that they're giving to you, or having you invest in, asking you to invest in. Asset management fee, okay, and that helps them maintain the staffing for to actually run the asset on your behalf, right? They got to pay people. Capital event fee, right? There's legal stuff that has to be done. There's time and cost that goes into doing refinances and selling, maybe supplemental loans refinances, as well as selling the property. If there is a construction piece on the property, you could expect to see a construction fee. If there's no construction and there's a construction fee, that's a question for the operator. Why is it there? Okay. Maybe they had to secure a key partner that pledged assets to get the loan or help guarantee the loan. There, you could expect to see a fee in there for that as well. And for me, unlike the key partner and the guarantor fee, it is an added fee. I'm not so bothered by it because I don't have the balance sheet to go get a loan for that asset. So I'm like, okay, somebody's pledging all their assets and they're on the dotted line in order for us to get access to this deal. I'm kind of okay with that. And then, but most importantly, the question you need to ask yourself, are all these fees performance aligned? And is what you're seeing in the pro forma net of all the fees? Or do you have to perform some sort of mental gymnastics to back out all the fees to figure out what your returns are? Okay, most operators are very savvy in the pro forma they show, the returns they show to investors. They'll show them net of all fees. But that is a great question to ask if you don't already know the answer to that. So quick question here. We'll talk about it in waterfalls, about the GP catch-up. I know somebody asked a question about that. All right, so let's dive into, we're going to talk about returns first on a little bit higher level, and then we're going to dive into, waterfalls. And we've got a couple more areas to cover here, but I want to make sure that we're, covering all different parts of this framework first, and then I'll go back and kind of clean up the questions box for everybody. So how to read the financials. I did that masterclass a couple weeks ago on this, so we'll just do this very quickly. You can always go back and reference that masterclass. But sometimes the returns that people are looking at, you need to pay attention to cash on cash return, internal rate of return, perhaps annualized rate of return, and then the equity multiple. Now, the next section are actually performance hurdles. Okay, so a preferred return is not a return. It's actually a performance hurdle for the general partner to hit in order to start sharing in the profits of the asset. So when you see a deal that has 7% preferred return, the first 7% of the cash flow and equity on that deal has to go to the investor before the general partner starts sharing in splits. Okay, so for us, we do a 7% preferred return. That's hurdle number one. Once we hit that, now on cash flow, we're splitting 70-30 with our investors. Okay, now you got the similar hurdles on the sales side of things. So when you go to sell the asset, we've got a 7% preferred return that has to be made up if it hasn't been done so already. And then we go to splitting 70-30 with the limited partner investor, okay, until we hit a particular return for the investor, so 13% IRR. And then this is on multifamily and self-storage, and then we flip it to 50-50. Now, somebody asked the question, what is the GP catch-up? Okay, so let me restate what we do, and then I'm going to give you a different model that has a GP catch-up in it. Okay, we have a deal, 70% preferred or 7% preferred return to the limited partner investor. Okay, then you split cash flow 70-30. Well, maybe the cash on cash for the deal never gets above 7%. So guess what? The general partner never participated in the cash flow of the asset. But then the asset sells. Okay, and then we actually split 70-30 until we get our investors to 13%. And then we change it to 50-50. And this is for, this is not on car washes. This is on hotels and multifamily, or multifamily and self-storage. A GP catch-up would be before the 77% preferred return, and when you sell the asset, the GP got the 30% cash flow. And then you went to splitting 70-30 to 13% IRR. That's a GP catch-up. The GP has inserted themselves in there and saying, hey, oh, by the way, I didn't get paid in cash flow while we were holding the asset. I want to get my cash flow. I'm getting caught up on all the cash I should have gotten. Now we've got equity. We're going to split that. Okay, so that's what kind of like what a GP catch-up is. There's different flavors of that. So that is just kind of one example. All right. Oh boy, guys. Okay. I had some additional information here to go through sensitivity analysis. Let me stop and unhide those slides. I must have hit them. Sorry, guys. You guys grab a sip of water. I know a lot of people are populating the Q&A box. Be sure to go to the Q&A box. If you have additional questions, do so, drop them in there. Yeah, thank you. It's some shout out and some love there. I love that. Tech happens sometimes. All right, let's get back to our conversation. Hold on. You know what? Okay, try it again. Hey, there we go. Third time's the charm, guys. All right. All right. So I promised you I was going to define some terms here. And again, we covered this on the webinar, a couple weeks ago when we talked about returns versus performance hurdles. So I'm going to go through this pretty quickly. But if you're looking for cash on cash, this is what you can take home based on what you've invested. That's the cash flow. Cash on cash means cash flow. All right. Internal rate of return is different. This is actually, it's a calculus equation. Guys, I took calculus back in college. I'm not a pro at this, but essentially the nuts and bolts of this is that it's showing you the returns you can expect once you've accounted for the return of all your capital. So if it takes a really short time to return your capital, hopefully the IRR is higher. If it takes a long time to return your capital, the IRR will be lower. So, you can see where, the holding period and then the cash flow for each period, those are all taken into account. And so typically, I know investors are like, oh, I'm going to go for a really high IRR asset. Well, if it's a 3-year hold, yeah, sure. But what happens? Have you performed a sensitivity, and do you know what happens if the operator has to hold for 5 years, 7 years, or something like that? All right, annualized rate of return. This is different. Okay, a little simpler of a calculation, but essentially we can calculate 2 different ways, including funds from distribution or excluding funds from distribution. Okay, but essentially it's just saying, what is my average return across all the years of the hold? Okay. And then you got your equity multiple. So a lot of times what's easy for people to wrap their heads around is cash on cash and equity multiple. But so an equity multiple, this is the present value of the asset. Okay. And when I mean like what you would get. So if you invested $100,000 in a deal, and between cash flow and equity, you got $200,000, but you only invested 100, your equity multiple is 2x. It's how many multiples of your initial investment did you get back? All right. The problem with the equity multiple, and just using that to compare, is that it does not take into account time. This is why you tend to see most operators do a 5-year hold. That way investors are modeled to a 5-year hold. It's one of the reasons, but that way people can kind of like compare apples to apples and understand if their numbers are truly better. Okay. So, and then again, we talked about the hurdle of preferred return. It's not a return at all. It's a performance hurdle for the GP to start sharing in money, or sharing in the cash flow of the profit, or the profit on the asset. So capital stack, okay. Again, this is part of our due diligence. We want to make sure that we understand where we are, okay, in the vetting process in the capital stack. Is there senior debt? Is there any sort of mezzanine debt? Okay, in this deal, there's not, okay. So the limited partner sits right behind the debt. Are there any other partner classes here? Is there a class A class? Do they get, are they being distributed to first before the class you're investing in? This is part of your due diligence process, your vetting process. You want to understand the capital stack and where you are. So the senior debt, they get the lowest risk, highest priority position for payback. You want to be as close as possible behind that senior debt, okay? Unless your goals and your risk tolerance dictate or allow you to take a higher risk and be lower in the capital stack. Now, then there's also the partnership structure. And again, this is what our conversation's been prepping us for about returns and hurdles, is you want to understand the complexity of the waterfall. Okay, who gets paid what and when? The capital stack doesn't tell us anything about that. The partnership structure does. Now, there should be some indication of this in the offering memorandum. If it is not there, then it must be outlined in the PPM. But what you would like to see is that in both and aligned. So you want to double check that it's in both. Okay. But remember, we're in the vetting stage. All right. So we will have that opportunity to check both. But in the screening stage, when we are only really able to look at the offering memorandum, we don't have the PPM to take a look at. Okay. So once you can't just screen a deal and not do any vetting. That's what I'm trying to say. Okay, so in this is one of our deals. This is a structure that I've already, explained to you. This is, the text for that. So how the waterfall works, Class A gets 77% annualized return. Any remaining cash flow is split 70-30. Okay, with the GP, and then when the asset sells on the capital side, the waterfall goes that you have to repay any unreturned capital to Class A, okay, make up any arrears to preferred returns, and then you start splitting the equity on the deal to 13% IRR, and then any remaining cash is split 50-50. Okay, this is a very kind of simple. It has a hurdle in it, but it is a very simple stack. and very much tilted in favor of the limited partner. All right. So that's got us through the capital stack. That's got us through the waterfall. Okay. We've also discussed the fees when it comes to equity. Right now, we need to talk about the sensitivity analysis and start kind of pulling all these things together to understand that primary thing, which is what is the business plan? Can it work in multiple market environments? Will we make money in multiple market environments? Okay, and that's where the sensitivity analysis comes in. All right, so sensitivity analysis is just a method that takes into account several factors that impacts the property's returns and helps you calculate a change in each factor that would affect profits. Okay. Now, here's the thing. It's important for you to understand, but just know the sensitivity analysis can be manipulated. All right. So that's why it's so important that when we were looking at that pro forma, that we understood that there was a conservative rent increase, conservative vacancy, that we have conservative timelines for lease up, any sort of construction. All right. Now, once we have conservative understanding of that, now the sensitivity analysis is something that the numbers are something we can trust. If the operator's swinging for the fences on any one of these things, the sensitivity analysis is really kind of bogus for us. We really aren't getting a good look at what could happen with this project. So here you go. This is one of our sensitivity analyses. On this particular asset, we said we were buying the asset at 4.2% cap rate. All right. And this is for an investor who invested $100,000. This is what it modeled. Okay. So essentially, we're looking here, the investor, if the market stayed the same, the cap rate did not change. Okay. We'd be getting a 2.06 equity multiple. All right. Now, if the market got better, we'd get a higher multiple on our money. Yay. We're all happy if the cap rate compresses in the market during our hold. But if the cap rate expands during the hold, okay, if we can no longer sell it for a 4.2% cap, but we have to sell it at a 5 cap, okay, our equity multiple, is that still something that we can tolerate? This is why having multiple levels to move the net operating income of an asset and understanding the business plan is so important, because if you have a solid business plan that increases income, decreases expenses, and adds additional streams of income, you can still make money as the market is getting worse. And that is probably the number one thing that investors are scared of right now. Like, if I invest now, what happens in 3, 5, 7 years? Okay. That's why the operator is so important. They have to have a business background and a track record for executing on their business strategy. All right. Now, you guys, we moved through a pretty big section there. Everybody, I went from having 5 questions that I needed to answer to 25, just talking about returns. I want to make sure with the time that we have, we get through the other pillars of the framework. If you want to stay on, I'll keep recording. I'll clean up all the questions for you guys. You will get a recording of this boot camp and can go back and review it later. But I ask you to stay on, because that way you can get, this is what this is. It's a deep dive workshop, so you can get your questions answered. All right, so pillar number 4, how do we vet the tax benefits of the deal? Okay, well, this is a little harder, and I'll tell you why, because I don't know of many operators that actually project out the tax benefits for the investor, because how the investor earns a return on the tax benefits is so individualized. Okay, but there are certain questions that we can ask to ensure that those tax benefits are there. Okay, so number 1 is you want to look for assets to where the operator is taking advantage of minimally depreciation. Okay, ideally with large institutional grade assets, I would like them performing a cost segregation analysis. That way they can take advantage of accelerated and bonus depreciation. Okay, at minimum. All right, now here is a couple of pearls of wisdom. Okay, just because somebody might say, hey, yep, we do cost segs, we do accelerated depreciation, bonus depreciation, we share that with our investors. You want to know how. Is it pro rata depreciation or is it some other split. And this blew my mind when I finally understood that operators can figure out a different split on how they share the depreciation with their investors. I was like, what do you mean it's not just pro rata? Like, why would somebody do that any differently? But they can. So make sure to ask. Also, if you're looking to build generational wealth, okay, especially if you have invested multiple times with an operator, I would ask if they do 1031 exchanges and do they have a successful track record of executing them. For us, we do that. That's part of our strategy, is to do 1031 exchanges. We want to partner with investors that want to do that, but certainly don't have to. But we're in to build multi-generational wealth. That's part of what our philosophy is as a company. But not all operators will do that. They don't all have their eye on performing 1031 exchange because they can be expensive and they can, quite honestly, like be a little hard to time and hard to promise to investors. But think about that. If that's part of your strategy, do you want to partner with an operator that does that? All right. And also an operator might say, hey, yeah, we do 1031 strategies or 1031 exchanges, but they might buy an asset to where they have no intention of doing 1031. So it's important to actually ask this on an asset, a deal by deal level. All right. Smart use of leverage. Okay, this pillar, we want to look at the lender, we want to look at the capital stack, and we want to look at the loan itself. All right. So the lender, is it public or private lender? Now, it doesn't really matter which, but knowing which type of loan you're working with might help you, right? Most people these days are working a lot with private debt because they can actually probably negotiate out prepayment penalties in lockout periods. But there's still a lot of great public debt out there. We call them GSE debt, Fannie Mae, Freddie Mac type debt. Most importantly, you just want to make sure that the lender is reputable and it's ideally somebody that they've worked with, okay, they have a relationship with. The capital stack, we took a look at the capital stack. You want to understand where you are in the capital stack and the risk if you decide to go further down, invest further away from the senior debt position, that you understand the risk of doing so. A lot of people are like, I want the big payday with equity, but they don't understand what that means, like in a 2 or 3 tranche deal. Okay. So understand, are you able to stomach the risk of investing in that position of the capital stack? All right. And then there's the loan. Okay. So when we're looking at the loan, I've got some kind of guidelines now, not really hard and fast rules, but I'm looking for loan to value 70, 75% or less, hopefully less. Now, loan to value, loan to cost are different. Probably, closer to, 60, 65% loan to cost, but like loan to value 70, 75%. I would love for it to be non-recourse lending, meaning that the lender, if the deal completely fell apart, the lender's not going to go back against the operator and try to, take them for everything in order to get the loan fulfilled. Rather, they would sell the asset and try to get the loan fulfilled. There's other things to, kind of check off on that. But most institutional grade assets will have non-recourse debt on it. I would love for it to be fixed rate, but if it is a floating rate debt situation, I want to make sure that there is a rate cap and that the operator has actually underwritten at the rate cap. Okay, they know what happens if that rate goes up. Now, I think a great question right now would be, has the operator underwritten and know how quickly that rate cap can go up? All right. And I think that's a lesson learned throughout this past calendar year for sure for many operators. Have they purchased extensions or negotiated extensions for deals? You want to see that? I like interest only for the term of the business plan, okay, for the hold, right? Because it's really not beneficial for you as an investor for the equity to get paid down on the asset, right? You're not going to hold it. Unless the business plan is to hold it, then it maybe makes sense to pay down the equity in the deal. But if you're trying to sell in 5 to 7 years, why pay down the equity on the deal? You're just giving more money to the banks. And then taking a look at that break-even operational expenditures, making sure that that has been, that break-even calculation has taken into account the debt. All right. Number 6, inflation hedging. Okay. How do we protect that pillar of wealth? All right. In our vetting process, we want to make sure that the debt is being locked in today's dollars. Okay. And paying it back with future, probably more devalued money. Right. That's how you arbitrage inflation. All right. But what does that mean to you as the investor? Like how can you kind of visibly see, is this a good asset to invest in? Is there a plan for the operator to be able to reliably raise the income regularly on that asset? Can they renegotiate, raise income, annually with lease bumps on multifamily, monthly on self-storage, nightly on hotels, right? This is one of the beauties of real estate. And are they looking to adjust their expenses regularly and work to pass that through to the customer? Okay, that's kind of inherently built in with investing in real estate, but those are 2 other levers that you want to pull. And then the last lever, and if you aren't going to run your own deal yourself, then you're going to invest in other people's deals. You have to vet the operator. Now remember, you've already screened them. You've already jumped on a phone call with them, right? But even when you get deal to deal, you want to do just a quick additional check. One, you want to make sure, again, that you're reading the offering memorandum, you're listening to the webinar, and there's been no additional material changes in the business. All right. You might have jumped on the initial call with the operator 6 months ago before you invest, right? Get on their email list, right? Pay attention to those emails, actually read them, make sure there's been no additional changes, that no red flags have crept in. All right. Talk to referrals. Okay. That will allow you to get a current snapshot. Now, some people ask for referrals, at the, I've talked to investors and they say, oh, okay, well, we might invest in the next 6 to 12 months. Can I talk to some referrals? No problem with that. However, you're not getting the most current snapshot in the business. I would actually save that referral ask for when you have a deal that you're going to invest in. Right? Because now you're going to talk to referrals and get the most current snapshot of most current business performance of the company. Okay. Now, legally, I would go online and Google the company name and put the word legal, or the founders' names in legal, right? And make sure nothing's crept up, like negative press or legal filings or anything like that. Okay. You'd be surprised of what can happen. And then, Edgar filings. All right. So anytime that an operator closes an asset, even if it's a 506B asset or C asset, they have to do certain legal filings. Even if it's an unregistered security, they actually have to file paperwork at the SEC. That all gets logged on the SEC database, sec.gov. It's called an Edgar filing. Sometimes you can go to another website that's called formsd.com. That might be a little bit easier for people to navigate, but you want to make sure that they're filing the correct forms. So that's another great little operational vetting thing. All right. Okay. So we've got 5 minutes left. I know I've got a ton of questions. Don't go anywhere, guys, but I want to wrap up and get those people here at a time that need to go. But your plan for action is once you go through your vetting process, right? Note any questions you have, right? So here is kind of what I like doing. This is not my actual spreadsheet. I've actually expanded this out greatly, but here's something, this is as simple as it needs to be. Go through and take those categories and those bullet points I gave you and drop them on an Excel spreadsheet, and then, understand what your ideal situation is, good, and then what you're like, I need to ask some additional questions. And you can just go through and just check mark, each category. Like, does it work? Does it not work? Right? Or do I need to ask additional questions of the operator? Okay. But go through the OM, go through the investor webinar. And when you have questions, reach out to the operator and then make a decision, right? Very important that you're getting to yes to stay in the deal as quickly as possible. All right. Expectations, your expectations should adjust with asset classes and market cycles. All right. Now, guys, you feel free, you can reach out to me at whitney@passiveinvesting.com, and I can share with you my current checklist, okay? Or actually not my current one, but my current model one that I have. What I will do is I will aggregate over the course of the week all the requests, and I will send one email out to everybody with those requests in there with the link to the spreadsheet. So guys, thanks so much. I'm going to start firing through some Q&A here. If you need to go, thanks so much for joining us today. I would love for you to let me know what you liked about Go to the Q&A. Let me know what you liked. Let me know what you didn't like. And you know, I'm always striving to improve these boot camps and webinars for you. All right, glasses got to go back on, guys. Let's see. Question came in. Yes, you're going to get the link to the webinar. If you're here, you're on the list, you were registered, you're going to get the link to the webinar. It probably won't be uploaded until Monday or Tuesday next week. Is it a red flag if the GP isn't rolling in their syndication fees into the deal as equity? No, that's not a red flag. I think the question actually is if they are, okay, so it's actually the question is, do you want to ask, is the limited partner putting in equity above their acquisition fee? Okay, so you know, most operators charge 1 to 3% acquisition fee. So somewhere you're probably landing like average of 2%. And if 2% only means $100,000, but you want to see them have like $1 million in the game, you want to, are they filling in that gap, right? So, you know, the question would actually be on screening, does the general partner roll in or invest, you know, co-invest in the deal above their acquisition fee? So I don't think, honestly, like newer operators, that's all they can actually probably put in until they get some sort of level of scale. But eventually I would like to see operators put in, you know, 5 to 10% of the equity for sure. And most of them will as they scale, because they don't get tax benefits unless they do invest in their deal. Okay, so they want the tax benefits too. Will I be sharing the PowerPoint slides? Guys, I'm constantly editing my deals, so I don't share the slides, but you will have links to the recording. So you guys can, you know, go and check that out for sure and rewind and do whatever you need to do. All right, I'm going to jump back up to the beginning here. Do I have a checklist you recommend people using when assessing these type of deals? Guys, you can email me. Again, I'm going to take all those requests. I'm going to lump it together, send one email out towards the end of next week. I'm happy to share my most current tool at that time. I am constantly changing and upgrading. And so I don't have like a set checklist. I actually encourage you as the investor to put together your own checklist, right? Because there are going to be questions in here that are more relevant to one person versus another, depending on what their goals are. So you can use this type of information as a starting place and then build out from there, right? These are, I wouldn't just take a checklist and just like, you know, I used to do that. I just used to, you know, use somebody else's checklist. And I'm like, well, it doesn't answer all the questions that I want. So yeah, I encourage people to build their own. Let's see. Ooh. Okay. As far as like, how does the operator, how to deal with the operator after you invest in a deal? You know, those are probably, you know, I'm going to take down, Abe, I'm going to take down your question as a note to probably do like a masterclass on, because that is like probably a larger topic than I can give it justice here now. How do you compare different percent of returns at different thresholds on waterfall chart between investment options? So, Terry, for you, you need to understand what is most important to your goals. Are you investing for cash flow, equity, tax benefits, some sort of balanced blend of both? Are you investing for diversification? Some people are looking for a self-storage only. Some people are like, I don't care. I just want the return to be X, right? And it's the people that are like, I don't care. I just want a return of X. That's where they're going to really have a tough time, because they're going to be looking at different deals with different return profiles and probably only investing on yield. So you need to understand the deal at a deeper level on how it relates to your goals and risk tolerance. Now, as far as returns, I would look at, I would understand cash on cash. All right. I would understand, the equity multiple, and I understand the internal rate of return. Those are the three that I would really look to understand and compare, contrast to different deals, but understand how time is a factor in there and how it can be manipulated. If you're not looking at deals with the same timeline, time horizon, that you can't really compare apples to apples. So, and again, different returns are going to differentiate on the investment asset class, multifamily versus self-storage versus car washes. It's going to differ versus, different types of asset like Class A, Class B, Class C, multifamily, even in different markets. So really, you need to kind of, build out your model of what you want to see. And the way I do it is, when I'm vetting here, I'll just use this as an example. Hopefully you guys can see my cursor. Under ideal, I might say I'm looking for an equity multiple of 1.7 to 2.2, right? And the reason why I put a range is because I know where my floor is. And then I know if I go above 2.2, those tend to have like a lot of risk to them that I'm not willing to take. So that's really what I would suggest doing. Like, as you build your chart, you're going to have the things that you're like, man, if I see an equity multiple of this, I'm excited. Let's go, right? That's going to be ideal. But then you need to know, okay, what's good for the market, all right? That's going to be like kind of your rooted range. Hopefully that kind of helped give you some guidance on how to look at this. What has the cash on cash been in the last couple of deals with our portfolio? I mean, we have done, oh my gosh, like in the past, like even 4 or 5 months, we've had, a 2 car wash portfolios, 2 multifamilies, self-storage. So you can't, cash on cash again is going to be different based on the asset class. So I think for us, our lowest cash on cash that we usually look at or pencil out is about 3.5%. And it's because we understand where we are in the market, right? And we're doing that very conservatively. And everybody uses the word conservative, but I mean, I can actually tell you, we've had conversations around maybe our underwriting is a little too conservative. But we're looking at probably right around showing that year one cash on cash and then growing it from there. And the growth is going to be different, whether it's multifamily, self-storage, or car washes. Our car washes, we're probably growing from 3.5% to 15% over 5 years. Right now with multifamily, it's probably 3.5 to upper, probably around 7.5%, maybe even higher, depending on the deal. And then self-storage, it's probably like, our last deal was 5.5% year one cash on cash, and then grew up from there, I think, to over 9%. So kind of all over the board. Again, you need to understand your goals and what asset class you're looking at. A couple comments in here. Somebody commented, like, I question seeing decreasing expenses on multifamily. I'd like to see expenses increasing, taxes, insurance, and personnel, at least keeping expenses the same. I agree with most of that, Agnes, but expenses I will think will always go up at some clip. And I think the most conservative thing is to not assume that they're going to stay flat. Now you can always ask, right? Like, if it's staying flat, why? Like, how are you so confident? So I've seen deals where it's been a tax rebate, right? And they're able to lock in taxes for 7 years. We've had a deal like that. Then yeah, you would not expect to see a tax increase there because it's a tax abatement deal. But there has to be some sort of unique strategy for me to believe that expenses would stay flat. Depending on how many partners, is that 2% split across the deal, or is it based on performance? David, I'm not exactly sure what 2% you're referring to. Maybe it's the acquisition, on the fee, the acquisition fee. That's just for the deal, okay? And it can be calculated based on capital raised. It can also be calculated on the loan value. So those are all great questions to ask for sure. The lowest factor is probably going to be based on capital raised. Frenchie asked, would the same terms apply to hotel? Frenchie, sorry, that was about a half hour ago. I'm not sure what terms we're talking to, but you can, if you can clarify, let me know. Preferred return is not guaranteed or return annually. Ah, okay, got it. Okay, so Abe, going back to the preferred return. Yeah, so the preferred return is not a return at all. It is a performance hurdle. Now, I actually have let's go back to our visual on preferred returns. Oh, I don't have one in here. So say you had a deal. I'm gonna go back to the end here so you guys have this. Say like you're looking at a deal and you see the cash on cash stays below the preferred return for all 5 years of the hold. Well, the next question is it cumulative or does it go away? Okay, so that is a great question. I actually have it on my underwriting sheet. I just didn't point it out in the actual presentation, but you want to make sure preferred returns are cumulative, especially if there's a delta between cash on cash being distributed for the year and then the preferred return. So definitely you want to make sure that it's accumulating. Not everybody does that. Okay. When asking if the GP has skin in the game, is it important to know if it is only as GP versus as an LP participant? It doesn't really matter. I think you just want to make sure that the all founding partners or managing partners have some sort of skin in the game. So, I mean, just think about it. Like the passiveinvesting.com isn't going to take advantage and probably write a check into the deal, but each of the managing partners would, because they want to get that personal tax benefit. So you're probably going to see that. Certainly you can ask. I don't know if they would like. I know, a lot of operators will share wires, but I don't think they would actually share the entity of which they invested. But you could probably get wire confirmation if that's what you wanted to see. I think that's fair to ask for if you wanted to make sure that the partners did invest. What makes the determination to issue Class A? That is, I think what you're referring to there is, let me go back here to our capital stack. This is, for this, the debt is the senior debt. Class A, for legal purposes, would be defined as limited partner, and Class B, sometimes called Class C, would be the general partner. All right, but the names of the class are going to change based on how many tranches are in the deal, how many levels of capital. So just because I called this Class A and that Class B or Class C means nothing, because in another deal, the lettering might be different. Right, so that's where it's really important to understand in the PPM, like, what is that defined class and which class are you in? Okay, and it's usually pretty easy to point out. There's usually an executive summary in the PPM, and I'm actually going to do a webinar in February, early March, on how to read a PPM. So getting prepared for that. Is 7% and a higher construction fee too high? I don't know. That is a great question. I don't know. So I've seen a range of 6 to 10%. I would say, and it really depends on what they're doing. If they're just doing paint flooring and carpet, you know, I would probably expect to see that like 6 to 7%. If they're like upgrading electrical, foundations, roofing, you know, moving walls, tearing out cabinets and stuff like that, I would expect to see higher because it's more labor intensive. So it really depends on what they're doing. Okay, so to flip it on its head, if somebody's doing just paint and, you know, paint and carpet and they're charging 12%, well, I don't think you're aligned. So really, I just make sure that it, you know, if you see the construction fee in there, what are they doing and does that warrant it? And that might be a great question for you to have with the operator. Because remember, limited partners and general partners, you guys are partners on a deal. Like you're going to be like in the deal for, you know, 3, 5, 7 years together, maybe longer. And so it's fine if you ask questions. It is encouraged. Please do ask questions. Okay, if you're unclear. All right. Let's see. Okay, so question came in, passiveinvesting.com specifically has a 12-month cash flow evaluation period for payment on anything above preferred return on multifamily assets. Can I explain that? Yes. Okay. So we described the preferred return, and let's say that cash on cash is above the preferred return. And it's not actually the preferred return. It might actually be whatever's noted in the pro forma. But for us, so this differs operator to operator. For us, it'll be the preferred return. So we'll go through, you know, say cash on cash is projected to be 9% for the year. And the preferred return is 7%. And we'll get to the end of the calendar year and close out all the financials for the year, make sure everything settles out, and then we'll distribute the delta. You know, generally it's been the delta on the pro forma. We'll distribute extra cash to the limited partner above. We have to make sure, you know, again, all reserve accounts are where they should be, all the debts and everything have been paid on the asset, all the expenses. And then if there's additional cash to distribute, we will, and we'll do it as a lump sum. So typically that's what you'll see. Yep. But we allow, you know, we want to make sure that, you know, all the books are closed for the year, because the last thing you want is for an operator to distribute out extra cash. All of a sudden at the end of the year, there's this big CapEx expense for X reason. And then the operator goes, uh-oh, we don't have enough cash to cover this. Oh, by the way, we need to do a capital call. That's the situation you want to avoid. Okay, so that's why we do it that way. And oh, cool. Somebody said nice job. Thanks, guys. I aim to please. All right. David, you said that was your question. David, I need to go back and find your question. Hold on. Oh, okay. So the question, David's question was on about the 2% split, or the acquisition fee. It wouldn't be per partner. It would just be 2% for the deal. Okay, and then that would so on the flip side, there's the general partnership probably has an operating agreement on how they invest into the deal, what their share class structure is, and that 2% acquisition fee and how that got split up for everybody would be outlined in that split, would be outlined in that GP operating agreement. And sometimes you see it, sometimes you don't. You know, but you know, it's kind of like if you invested into a deal with us through an LLC, we don't ask to see your operating agreement, right? We just need to know it's you. Same thing. You know, that you know, acquisition fee would just be defined in the PPM that everybody sees. And then, you know, how it got split up and, you know, utilized would be, you know, that's a business, you know, topic. Okay. All right, guys, I got 12:15. I feel like I've gotten through, you know, most of everybody's questions. You guys, thank you so much for joining today. If you got additional questions, you think of them later, feel free to email me. Otherwise, have a fantastic day. And as always, thank you so much for taking your most valuable time and spending it here with me today to invest in yourself. All right, guys, take care and have a great weekend.